Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday, number 368, our first of 2026, and our last one of our 13 years of doing webinars, our final one of the years for that particular purpose, starting season 14 next week. So, good afternoon. My name's Kelly Bearden, and I am the director and host today from the Cal State Bakersfield Small Business Development Center. And we're going to look at the big picture for 2026 funding, profitability, some of the other issues in order to take that big global look at your business. We flip the calendar. It's a great time to look at the possibilities that your small business can be. So let's look at a couple of those today. We also have a special guest we're going to sneak in a few minutes. So a lot to go over today. Big picture small business is going to be the theme today. Look at the big picture as we flip the calendar and we look into 2026 and we look at what our small business can be and a lot of the things that are going on. So we're going to kick off 2026 by doubling down on both some of the capital that's out there, some of the capital issues that come up, and look at a little bit of profitability and increasing profitability and how it can help us. So, doubling down on the capital aspect of it, really kind of looking at a couple of factors that are really pivotal in the process of trying to get a small business loan in order to try to get some form of capital in order to start, grow, or even transition that small business. We're going to also kind of look into your borrowing capacity. And it's really one of the things that I think we skim over a lot here on Webinar Wednesday, but we've never really done a deep dive. And really, the first place to kind of look at is maybe looking at it through a lender's lens. Oh, and I like that. A lender's lens. And look at that and see what is actually your capacity. How much can you borrow based on your financial results if you're an existing business? Or potentially your financial projections and how you project it to go as far as your small business if you are a new or small business startup. That can also be the case if you're purchasing an existing business that is going to change dramatically. We do have a special guest today, so to break up the monotony of me, it's going to be a live look in on an SBA disaster that is currently going on in our CSU Bakersfield Small Business Development Center region. And we'll bring in LaMonica Lacey in just a couple of moments and let her talk about a disaster that looms. And, why not break into the 2026 webinar season with a disaster in our region, okay? We are used to these. We are resilient, and we're going to talk a little bit about one today, a little bit about the disaster loans that are available, and also one thing we talk about a lot in the past on Webinar Wednesday, and that's the economic injury disaster loan that you can actually apply for, even if the disaster happened a long ways away from you. So we're going to jump into a couple of our regular features here on Webinar Wednesday, and that being capital quarter. And so we're going to look at a plan, to raise capital. We plan about a lot of things in life. We plan our day, we plan our month, we plan our year. We have a business plan, we have maybe a marketing plan, a lot of things, but maybe we need a capital plan as well. And looking at the things that lenders look at, looking at, of course, again, going back to what we just discussed as far as your borrowing capacity. So we can look at a plan, and we'll talk a little bit about what that plan might look at today. And we'll talk about a lot of different factors on capital quarter. We're not going to get into it too much on our economic corner, but there's a lot of economic woes to watch out for. There's a lot of things going on in the economy that affect our business. We'll talk briefly on those, and then we'll bring back our economists in the next few weeks and really get into a lot of the things that have really shaped up to be, over the last year, really a dynamic part for small businesses, and that's the general economic conditions and what to look out for and look out to ways to where you can benefit by knowing what is going on and what is happening in our general economy. We'll talk briefly, won't get into a lot of the new laws and compliance issues and regulatory issues, but we'll try to jump into a few of those that are going on if we have time. Your questions are always appreciated here on Webinar Wednesday. So after today's presentations, please jump into either the Q&A box or you can jump into the chat today and we can look into some of those questions that you have. We'll have links and resources that are provided by our Webinar Wednesday producer, Maureen Busherdang. And Maureen will be working the back end of things today in the chat box. And with all the things going on today, and I mean, there's a lot of things going on today. Trust me on that. We're not going to have a poll today. So, but that brings us to a feature that we do have on occasion on Webinar Wednesday, and that is the live look-in. And we're going to bring in our special guest, as I mentioned, LaMonica Lacey. So, LaMonica, join us, and please let us know a little bit about the disaster that's going on in our SBDC territory, I believe up in Mono County. And I've been so motivated by the disaster that there I am with a background in Mono County. So, LaMonica, it's great to have you joining us on Webinar Wednesday, and take it away, please.
Thank you so much, and it's so good to be here. So the reason for this visit is just to let folks know what's going on in Mono County. Recently, there was a disaster, and unfortunately, this happened last year around November, between November and December of 2025. Because of that, we are here, Small Business Administration, to offer low interest rate loans to homeowners, businesses, nonprofits, churches at a very low interest rate. Right now, those loans are coming in at about 4% for a business and at about 2.8% for homeowners. What we do is we offer these loans at a fixed interest rate, the interest rates that I just spoke about, and they're deferred for the first year. So for the first year, for the first 12 months, there is no interest that's accruing and there is no payment that will be generated. After that, you will generate a payment and the interest rates will start. One of the good things about this loan and about what small business does is we offer up to 2 million for businesses at economic injury and up to a half a million for physical damages for homeowners. We also have content replacement for about 100,000, and that's for a renter or a homeowner. The reason that we really wanted to get on and share with individuals about this particular disaster, we have contiguous counties that may be indirectly affected as a result of the fires that happened in November of last year. That indirect effect could be a person who's an Uber driver, a person who's a caregiver, a person who may have rented space in the Crowley Lake area for gaming, fishing, maybe taught classes, and now that particular business has stifled. And so we're here to let folks know that there is an option, not required, not mandatory, but this is an option that you are eligible to apply for assistance through a U.S. federal Treasury Department who backs these loans through the Small Business Administration. So that's pretty much what we have right now that's going on. Wanted to kind of go over some of the areas and some of the contiguous areas that would be eligible. Those counties would look like Alpine, Fresno, Inyo, Madera, and Tulum. Those are in the California area. But the other areas that are indirectly affected as a result of this particular disaster would be like Nevada, Douglas, Lyon, Mineral. Those areas are also eligible for economic injury, and they can apply either in person. We have in-person services. We know people may not be able to get up here, but we do have in-person services until the end of this week at the Crowley Lake Community Center. And we also have online services that are available anytime by going to sba.gov. You can also call our 1-800 number, and we have customer service reps that are available to assist. That number would be 1-800-659-2955. So that's a little bit about what's going on here in Mammoth and how we want to extend the opportunity to individuals that may be indirectly affected and are eligible to apply for small business administration for our small business loan.
Great. If I might be able to ask a question or two, it would probably be somewhere along the lines of with SBA disaster loans on this particular disaster and others, you have basically those that are directly impacted. I remember this pack fire that started in Crowley, I believe it was in probably October or November, was when the rest of the state had some driving rainstorms, had this atmospheric river that hadn't reached there yet. I think it eventually helped put it out, but it was burning in an unseasonable time. So enough on the backstory, but on the front side of things, you have those that were directly affected by that, that were actually burned. And then you have the economic injury disaster loan that affects those contiguous counties, I should say, of which it actually is those that were harmed economically. Can you talk a little bit about the economic harm that some people might have that are in those other areas?
Absolutely. So working capital is so important, especially to small businesses. We realize and recognize that small businesses, no matter if it's a week or a month, that can stop their cash flow. That week or month, we don't have the proclivity to really see so far beyond what their cash flow would look like, but we would hope that within that, like, let's just use the 6 month range. If something like this happens and it stops the cash flow for 3 to 4 months, that they would have a backup, an option. That's where we come in. That option would be you can apply for the economic injury loan, and that would assist with operational costs. That can assist with your payroll, with anything that has to do with the operations of your business. And again, that loan goes up to $2 million. So if you have any kind of break in your business, we really encourage you to apply for the loan. Again, it's not a requirement. This is just an option. All of our loans are backed by our our Federal Treasury Department. So it's not an individual loan that's a Monica loan or a Kelly loan. This is a loan that our people are all eligible to apply for as long as you are in that contiguous county. So yeah, it's a really good loan to have, or an option to have that working capital, that cash flow, and to use for your operational expenses.
Fantastic. So Maureen has put in some information on the pack fire that is in our chat. Some other comments. Lynn, our very, very good friend, Lynn Gannon, said it was horrible in the area. So it was really something that was really, really, really unexpected, I believe, given the fact that most of the state was under torrential rain.
Yeah.
And by the time it got to the far eastern part of the state of California, all this damage had been done. So, are you able to stick around and maybe if we have some questions toward the end, LaMonica?
Absolutely. I'll be around. And so if anyone has any questions, I would love to help and answer anything that I can.
And let's make a pact that, the first webinar of the year is maybe the last that we talk about disasters here in our three-county area.
Yeah.
But that's
Sounds like
probably
a
not going to
plan.
happen if history repeats itself like it always you see.
Kind of, sort of. It kind of, sort of does, Kelly. Well, I'm
Well,
here.
thank you so much, LaMonica. Appreciate you taking the time to make us aware of what is going on in that particular area. So thanks again.
You're very welcome.
Okay, moving along on Webinar Wednesday, we're talking today about the small business in the big picture, looking at our big picture for 2026. And really, what this does is it allows and gives you the time to really assess objectively the state of your small business. It has been such a dynamic time over the last few years. Pretty much this entire decade has been just a very difficult period to run a small business with major changes, starting with the pandemic to where we are now, starting 2026. So the back half of the decade really gives you the opportunity to look objectively at your business and to really dive into spending and looking at times. And one of the things to look at is you're going to be now working on in the next, some of you in the next month or so, maybe others longer, but you're going to be looking at that 2025 tax return. And for a lot of purposes, that 2025 tax return will tell you a lot of things that are going on in your particular business. And it's really a telling time because we're gathering and we're finishing our 2025 year. So the financial information will also tell us some things that our lenders are going to want to see if we look at the funding side of things. So what we're going to look for is we're going to look for trends that are happening in our business. We're going to look for other developments that are moving forward. So a lot of the trends that have been happening over time and a lot of the things that might have been happening in your business now maybe give us a time to either take advantage of that. Maybe it's an opportunity, or also maybe look at maybe fixing a particular issue that is going on. So those are some of the things that I think when we flip the calendar, it's really a great time. So one of the things you might want to look at is when we're looking for funding is we always like our clients to be able to look before you leap. And really, that is an excellent opportunity to get to know the SBDC. And we'll go over some of the things that we're looking at as far as the funding side of things. One of the things that we talk about a lot on at Webinar Wednesday, and really as we flip into a new year, is cash flow. And a lot of the times we provide a annual cash flow on a single piece of paper. We're going to talk a little bit about today about the 13-week cash flow. So that is breaking your cash flow into 4 quarters and looking at it on a uh, much more, I would say, urgent basis, and really kind of looking at cash flow in order to kind of drive that forward. Again, we do recommend and encourage you to find a mentor. If that's the SBDC, great, but really a sounding board and somebody who you could talk to that you have earned trust with is really such an important factor. So one of the things that we always like to say here at the SBDC is, it's really kind of knowing how much cash you're going to need in your business, but how much your lending capacity is and how much you can borrow. So oftentimes when we start talking about borrowing, we look at one thing. I know when clients come to the SBDC, it's going to be my first question on the funding side of things. And it isn't how much money you necessarily need, but it's also how much you can get by with. So knowing how much cash you need or how much money you want to borrow kind of comes into consideration that's a little bit different. I understand totally. I want to get you how much money that you think you need and how much money you need for your particular business. But sometimes how much you need isn't how much a lender is going to give you. So then it's going to be more like instead of how much you want, how much can you get by with? How much do you need? And we'll look at that under the borrowing considerations in just a moment or two. And also, just a quick little thing on really as we flip the calendar year and look at the big pictures, it's all about customers and generating sales. And it's really about the quality of customers compared to the quantity at times. So we'll get briefly into that as we chase my favorite graphic of 2025, and that is that wonderful $100,000 bill. And so, one thing we're going to jump into first and foremost when it comes to lending is there is one lending aspect that most people don't know about, and that's the debt service coverage ratio. It is the most important ratio in small business lending. It is something that if you don't hit this number, and it's a very simple formula, we talk about cash flow here for a reason, and that is because your net operating cash flow is divided by the total annual debt service. And if you don't meet that particular ratio, no matter how great your business plan is, no matter how wonderful the rest of your financial projections are, the opportunity that you have, the business opportunity, it's not going to happen, at least from most lenders' standpoint. So really meeting this is really one of the things that we talk about when a client will come in. Are you able to meet this particular ratio? So let's learn a little bit more about the debt service coverage ratio. So lenders use this. How they lend it, how they use it particularly, is they have a minimum. And a lot of our SBA lenders and a lot of the traditional type lenders that we work with, what they want to see is that you have a 1.25 coverage of that. So going back to the particular ratio, we now know that we're looking for 1.25 in most cases. In some cases, some of our lenders are nonprofit lenders and some startups, we can get by with 1-to-1. And if you're 1.5, oh boy, you're a strong borrower there. So, and again, going back to the formula, it's the net operating cash flow. So when we look at net operating cash flow, it's the money that you make in your particular business. It's that profitability that we were talking about. But the profitability coming in the form of cash, which can be a little bit different from your financial statements, but this really breaks in the cash aspect of it divided by the total debt service, debt service. So, knowing that we're looking at 1.25 as pretty much of our goal, let's see how much our lender will allow us to borrow. And sometimes that is really, when you get a set of financial statements, really something at the SBDC that we look at. How much will your lender allow you to borrow based on meeting that particular guideline? And it does depend. So let's go into an example of your debt service coverage ratio. And looking at it is, I'm going to do things backwards here. Okay. I'm going to look at, well, number one, I know it is basically 9%, which is the interest rate that you might be paying. And we'll pick a term, the term for these particular assets that you're purchasing. In this case, I'm going to use, maybe it's equipment for your business and rolling stock and maybe a little bit of working capital, and you're looking to expand. And your monthly payment is based on, our $100,000. So if your business showed $100,000 of cash flow, can be different from profit. Things are added back, and it's not as easy as just looking at your profit and loss statement. Cash flow is different. It is determined by cash rather than generally accepted accounting principles. So in this case, I came up with a monthly payment of $83.33 because I'm looking at this backwards. I'm going, I have $100,000 of cash flow. I know the interest rate's 9% and I want a 10-year loan. I think my 10-year loan, how much can I borrow based on that? And the amount that I can borrow is, going back slightly, is $657,821.13. Now, I know not too many of you come in here and ask your SBDC advisor or myself, hey, I want to get a loan for 600 and I need $657,000 or 657, 8, 12, 13. Okay, I know that's not going to happen. But at 650, it kind of shows you the limit that based on your debt service coverage ratio that a bank is going to approve you for. So knowing that ahead of time is really helpful because you might not need the whole 657,821, but you will at least know that you will be covered based on that amount. Okay? So that's kind of backing into it. One of the ways that we back into using the debt service coverage ratio to make sure that your lender is not going to deny you for this purpose. Now, if say you only want a loan for say about $65,782, then maybe we just take 10% of this, and look at it as, you know, you only want a monthly payment of $833. You need a much smaller amount. And so having you can afford an $833 payment based on your cash flow and based on the same terms, then it would be a loan of about $65,700. Okay. Just for context here, we've gone through the debt service cash flow ratio from a percentage standpoint, from a formula standpoint, but it's important to know how it affects your availability. So, based on our first assumption that you're borrowing $657,000, your annual payments would be around $100,000. So, to meet that ratio, you would have to show a net operating cash flow of 125,000 per year. So that's going to show a net profit of, near that amount or less. But there are certain add backs that lenders will go to. They'll take your tax returns and they'll say, gee, you've bought these assets beforehand that you're now charging off for tax purposes through depreciation. We can add that back because depreciation is not a cash charge. It is a financing transaction for tax purposes. It's a cost recovery method of when you purchase an asset and really utilizing that for a longer period of time. So that's one example. So on a stronger basis, it would be the 150. So moving on our debt service coverage ratio, as we continue to explain it, it's cash that's generated from operations after operating expenses, but before owner distributions. So we run into this thing that we won't get into, EBITDA, which is earnings before taxes, depreciation, and amortization, or cash flow from operations, accounted for add backs that I just explained. And then our total annual debt service is going to be all those required principal and interest due within the year. So why does this make sense? Why does this try to make sense? And the reason it tries to make sense is that, first and foremost, one of the things that you could run into is not knowing exactly how much you can borrow. And what we really want to do is try to show you, based on your financial results and your cash flow, what you can borrow. So in looking at that, now, I'm going to stop my share and I'm going to do the attempt and actually try to pull up some other type of example for you. Finally, yes, there we are, our 13-week cash flow projection. And this can be included into your forecast. This is great for if you're really in a shortage or if cash is really, this is how you really manage cash tightly. I cannot recommend this enough. And it's basically, you can go in and adjust these dates. I haven't adjusted the dates in a while on my example, but the way the 13-week cash flow will work is it'll work with basically your sales projections and then show how much cash you have coming in. And then you have your cash coming in on a weekly basis. You can set those weeks for the quarter. And the nice thing is you can go back and you can actually adjust this on a weekly basis. So if cash is tight in your particular business, this is outstanding. Lenders love this thing. They love a cash flow forecast on an annual basis that we use a lot, but on a weekly basis, it's even better. So really going in and projecting what you're going to sell, you can do that for the entire quarter if you want. You can do it for the month. And then you can actually track and see how close you were on that. And you can pull your cash in based on cash that you receive in your business. Some of the businesses that we deal with, their cash comes in all in one day. And some of them, they sell on terms and their cash will come in over a longer period of time. But by using this example and really kind of using cash and using cash receipts, your credit cards, if those come to your account on a daily basis, you might have a line of credit that you might need to pull from, and that can actually improve your cash aspects and other aspects. So what it does is it shows you on a weekly basis what your cash receipts are, and then it shows you what your regular expenses or disbursements are. And you can set these up and actually use the actual each week to where you show those, and you can customize each of these to your business. And then at the end of the month, it'll show your cash on hand that you have, and it'll show over time if you have positive cash flow. And that's really important if your cash is tight and you're managing cash. The 13-week cash flow projection is, I think, one of the greatest tools ever invented. It's a little bit of work, but it really shows you when you're going to have surplus cash. It's going to show when cash flow is improving and also show you periods of time that you're going to be short of cash. And if you need to, try to come up with cash for those particular periods. Again, we will include that in our email that goes out this week, but I think it's just a great tool that many people would really benefit from, and really kind of gets back to the example that we showed with the one formula being cash flow. So being able to show cash flow increasing, if you do this for a quarter, you'll see what your cash flow is times 4 on a projected annual basis. Another regular feature that we have is our economic corner. Having touched briefly on our capital quarter for today, our economic corner contains a lot of different aspects as well, a lot of factors that go into. And the general economy is really something you can't control as a small business. And it's really the one thing that can have a devastating or an extremely positive effect on your business. So that said, understanding what happens and the advantage that it can give your business, our webinar Wednesday resident economist, Dr. Mark Evans, will be returning soon with updates to keep you in the know. So I'm not going to jump into the economic side of things today. Profitability and really kind of understanding what your needs are and formulating that particular plan that you have are some of the things that are most important for you. And so getting into some of the changes that we have in 2016, there's a lot of labor changes and a lot of law changes, and we get a little frustrated about some of these at times. And jumping into some of the changes that actually occur, we do know, most of us, that the minimum wage has increased and some of the other factors that are going to be affecting our particular business. We're not going to get into those a lot, really heavy at this particular time, but those are some of the ones. That is one of the ones that is most important. That obviously from day one that you recognize the minimum wage has increased to $16.90 in California, and some of the other things that we think that are important that you might have missed in 2025. For example, the Cal Savers program. For those 0 to 4 employees, if you have not implemented that particular change into your particular business starting this year, it is something that we're going to remind you moving forward and probably talk about a little bit more. But really jump into the Cal Savers, and if you have employees that want to participate in that particular program, Cal Savers is a retirement program that is mandated by the state of California. It was implemented for larger employers, and this last change, starting on January 1, 2026, was for those that have between 0 and 4 employees. So what it is it's a state-held fund that you pay into as an employee, but not as the employer. So if I want to have participate, say, as an employee, my employer can have an employee deduction that is remitted to the state of California, and then you have a retirement account for those businesses that don't have a retirement program. So that's basically what that is. Those are the two things I wanted to touch on, particularly today, given the absence of not having a great deal of time. Just also to remind you of a lot of our SBDC tools that help assist your particular business. Jumping through those particular tools, one of the ones that is going to be most advantageous in helping you with your numbers moving into 2026 is Vertical IQ. We'll have a program coming up on that in the coming weeks, and talk about how you can work with your SBDC advisor on a lot of the industry numbers and a lot of the industry data. Industry information is so important because you can take what you have as your own particular business and then compare that to the industry as a whole. So lenders will look at that. So let's say we jump through our hoop and we're able to cash flow the size of the loan we want, basically, and meet the discounted coverage cash flow or coverage ratio. Great. So what else can trip us up? Well, one of the things the lender is going to look at is it's going to look on how our business is compared to the industry. And it's always good for you to know going into meeting with a lender how your business actually competes with the rest of your industry. Lenders will pull up a report that shows, the average based on your NACE code, based on an SIC code. They will pull up based in your particular industry and they'll compare your numbers to that. So it's always good to know that going into that. So Vertical IQ is perfect for that. Uh, we stand behind and really use a great tool in LivePlan. So LivePlan is a great interactive planning tool that you can work with and actually work free of charge through a limited time with the SBDC. We think it's a great tool. Gets your business plan and really gets a lot of the strategic planning that you might have had in your head, but you really haven't got into paper. I'm a believer when you business plan and when you look to strategic plan as the big picture for 2026, it doesn't matter if you use a fancy live planning tool like LivePlan or business planning tool like LivePlan, or if you scribble notes on a particular piece of paper or in a notebook. The important thing is that you visit it and you visit it frequently during the year and you update it as you go. However you plan best is the best plan for you. So LivePlan, we find a number of our clients really have tremendous success with that. Those are two of the tools. One of the tools that I like using also is our capital assessment form, our capital assessment tool that really takes a lot of the financial information that you have if you're looking for funding and moves it forward into understanding big picture what you can actually apply for and what you can qualify for as a small business. I think a lot of us think a little differently than I do. A lot of us think differently from the standpoint of I like to take what a small business lender will give us based on the financial information we're giving them rather than the other way around. And so that's the thinking that I'm starting 2026 with. Okay, so some great tools here. Other ones we'll go over throughout the year at other times. This webinar will go where our other webinars go, and we now have over 500 subscribers to our CSUB SBDC YouTube channel. You'll see a lot of different opportunities to go back and look at some of the funding opportunities, ways that you can make your business more profitable. So maybe that is just maybe customizing this channel to particular topics that you want to watch in 2026. If you want to review today's webinar for some reason, it'll be here. It'll be here probably by the weekend. One of the things that I think that is really important, and since we are live today in Bakersfield, California, right here in the heart of Kern County, one thing in Kern County we have come to realize is that small business is huge toward the total payroll in this particular county. And we see in Kern County, for example, between 0 and 49 employees, it's nearly 40% of the county. 40% of the payroll in the county comes from firms that have less than 50 employees. Whereas in the state of California, that's only 30%. So a huge difference, a third, or 33% higher, basically, in depending on small businesses between 0 and 49 employees. So it is huge. And the role that small businesses play in Kern County is massive based on that. So understanding that, we're going to be here to help you. And one of the ways that maybe is a great tool and maybe a great way to get ahead in 2026 is to get that data advantage. And that data advantage can come from some of our SBDC teams. We have experienced senior level advisors, consultants, and we pair them with our student interns, our CSUB AI interns for a solution in 2026. We're working on different industries right now and several different models, but really the information that can come out of this leads to decision making that you make in your business every day. And so getting that SBDC advantage through AI solutions and getting the data that you need to make the business decisions that will help your business in 2026. You can email me if you want more information on that. We are part of an association of SBDCs across the country. Our trade association has the AI University. And yes, that is the Artificial Intelligence University, to where we have certified AI users here that are certified through a program we went through with Google. There's one of our lead advisors, Jay Thompson, uh, ACE consultant, I might add. And you can sign up at our CSUB SBDC for free, confidential, no cost, no obligation expert consulting that is available to you at this time. And we want you to win. We want to see you win and win, and no matter how you have it, on the gridiron or with that particular bill right there. Capital Quarter helps you win. Again, thanks to our sponsors. We're going to jump into some questions, but the County of Kern, California, we're powered by SBA, the Office of the Small Business Advocate, our Blue Tech Valley program, SynCal, and the College of Business and Public Administration. Thank you all for being here today. If you appreciate what we're trying to do here for you with today's webinar, go to Google and give us a nice review. If you have any other questions, you have my email, contact me. Glad to talk to you about that. Can't use this enough. Minimum typically, cash flow is so vital. So to have your debt service coverage ratio at 1.25%, it can be as low as 1.0. Let's work on getting that up in 2026. So with that, I'm going to stop my share. I'm going to give you an opportunity to ask some questions. We've got a few minutes left for that. So please ask questions. I don't see any at this time. So let's start off by going through the particular chat that we have. So our particular chat box has information for you for the PAC fire, for idle loans, for those that were impacted in Mono County. There is another link. Your public affairs specialist, LaMonica Lacey, thanks again for joining us, through the Office of Disaster and Resilience to contact her. We can make these slides available to you. Maureen will send those out to you. She's also going to send that wonderful 13-week cash flow forecast. And if you want to meet with an advisor and put that together and work with that and continue to use that on a regular basis, please jump into that. The Cal Savers program, which is now mandatory for all businesses in California. You got by for a long time if you had 0 to 4 employees, but that is over. The Cal Savers program, and to learn more on that, jump into that and get in compliance with the state of California on that particular issue. There's a link to our CSUB SBDC YouTube channel. Information now also, if you would like assistance from our intern or any assistance at all, that we are really diving into this AI and really we think that you have some interesting things to learn from that. So, and if we'll jump in and see if there's any questions at this particular time. And I don't see questions until I go over until to the Q&A. So let's see in the Q&A. Okay, first question. Given the current situation, is it better to take a loan or go for credit cards? Okay. Well, and again, that's going to depend on basically your borrowing capacity. So on that particular question, I think that there are a lot of worse alternatives than credit cards out there, particularly your MCA, your merchant credit accounts. Those are usually worse. A lot of the online borrowers that you can get money for quickly, oftentimes at a super high rate of interest, and a very, very detrimental aspect on your cash flow, are worse. Credit cards can actually be a lifeline for some businesses to get you to the point to where you have that capacity to borrow. used right, interest rates can carry a 0% rate, but even when we're looking at 9%, we see some introductory rates that are designed for business owners in the 10% range and even a little bit higher. So it depends on the particular borrower itself, and it depends on, comes back to your capabilities and your possibilities for borrowing and all the alternatives that are out there. The one thing about borrowing is that it's usually contingent on how much money you want to borrow. It's always easier to borrow a smaller sum of money in most cases, but but it's case by case business basis, and that's why it is so vitally important to talk to an advisor before you start talking to banks and getting the situation and getting your particular loan package ready before you talk to lenders. The next question is, I hear you have some great AI and also CSUB student interns. Tell me a little bit about them. Well, I did already. I said we have a great tool, a great pool of interns and others that are out there. So really, to talk to them and us, sign up. What can you say about no tax on overtime? Well, I try to stay out of the tax game. Stay out of the tax side of things. So generally, you know, I think it's in the new tax things. Contact your tax advisor on that. What are the most common cash flow blind spots that small businesses run into? Okay, that's an excellent question now. Um, I think a lot of things that have happened over time, and we do have time for questions for LaMonica as well. But some of the cash flow blind spots that small businesses run into are those when you have large, maybe unusual payments. And let me say, for example, that could be insurance, it could be property taxes that are only generally maybe 6 months, twice a year. So you have a larger amount that you're paying for the whole year on rather than a monthly basis or a weekly basis. So those are some of the blind spots that pop up. But it can also be normal things in your business, such as shortages, supply chain issues, and things like that are hard to account for until you get into it and you're looking at it on a case by case, week by week basis. So those are some of the things that are out there for that. Okay. See if we've run into anything else. I think that's about it for today. Any last comments, LaMonica?
Yeah, I just want to encourage anyone who knows of anybody that may be indirectly affected to just encourage them to go online to sba.gov and register. Again, it doesn't hurt to register, at least have that option on the table, just in case anything happens with your working capital, your cash flow. We're really here to help you. And please feel free to reach out to me if you have any questions outside of this disaster. I'd be glad to help you and walk you through our program.
Fantastic. And thank you for all you do with SBA disasters. And I know you guys tend to be very, 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 very busy at times. So thank you. Hey, we had a question pop up. Is there a simple way to calculate DSCR, debt service coverage ratio, from a QuickBooks report? And so for that, I'll say from your accounting statements. And you can modify it, but yes, because you can start with your net income and then you can either add back issues such as depreciation, amortization, and a few other things. So you can take your net income and then do certain add backs that increase cash flow. And then, divide it by the denominator. And so that would be one of the ways to do it. And some of the non-cash items generally are going to be, what we see uh, are going to be depreciation, amortization, and such. Now, one thing that you do run into also, you'll hear the phrase global cash flow. And global cash flow is important because global cash flow will pull into your entire household situation. So oftentimes you might have a spouse that has a business and there could be cash flow from that particular business, or your spouse has a job that is generating cash flow. And so there are other terms out there, such as global cash flow, that can go into that debt service ratio calculation. But really, just I can't stress enough the importance of that particular ratio and understanding what it is and where you sit with that before you ask questions. Um, Usually, when we'll have lenders on here, they'll come on here and they'll very casually say that your debt service coverage ratio needs to be 1.25%. And I can guarantee you that 90% of the people, sometimes including me, don't know how that's calculated or that's that important. And it could be everything else is vitally in order, everything else is perfect. And then that thing ends the deal right there before it even gets going. Very important. So it can be generated from the start of financial statements and then kind of adjusted to where it's on a cash flow from the business. Okay, well, that's going to wrap it up for webinar Wednesday number 368. Thank you so much, LaMonica, for joining us today. And we'll be back next Wednesday for webinar Wednesday number 369 for LaMonica and Maureen. I'm Kelly Bearden. We'll be back next week. Everybody have a great week. See you then.